Okay, let's get started again. And I'll go through the slides on risk parity and show you some ETFs that show different comparison between market cap weighted ETFs and alternative alternative weighting schemes. And yeah, just to set some context or remind you from the where we just left off. So we looked at all these different ways of constructing a portfolio or coming up with weights to a portfolio that do not follow market cap. So there was like maximum Sharpe ratio, equal vol weighted, and then we drilled down a little bit more into risk parity, which is an approach that's in between not believing in anything, that you can estimate anything. So like a 1/n approach versus a full mean variance optimization where you believe that you can estimate not only volatilities and correlations, but also returns. So I will continue to drill down a bit into the risk parity. Let me start sharing the slides now. Okay, so yeah, we finished that derivation. So the issue with implementing risk parity is that it has the idea of allocating more to bonds at the expense of equities and perhaps providing leverage to get back to the same return target. And if you think about it, and this is strictly true this year, but it was also apparent in previous years that it doesn't seem such a good idea to leverage up fixed income, given that yields have come down so much. And so typically like the expected return, your best estimate for the expected return for fixed income is the current level of yields. And we just saw in the lectures that the current level of yields for example, the US 10-year is about like 60 basis points, which is not an at all attractive return. In fact, in the previous lecture, we even showed that the term premium, or in other words, the risk premium you get out of fixed income is actually negative, something like minus 1%. So when talking about risk parity, it seems imprudent to not only have fixed income in your portfolio, but to actually have even more of it. So I would take this to mean that in general, like if markets were kind of in some kind of equilibrium state, in other words, they weren't distorted by central bank actions, that risk parity makes perfect sense. But we're in an environment where there are such extreme distortions that it wouldn't be a good idea to advocate or implement risk parity just on the pure equity versus fixed income asset classes. But is there anything you can do to improve this a little bit? So one idea is you can include more building blocks. The other thing is that you could apply risk parity within the building blocks. So let's say within equity, you could apply risk parity to the sectors or the individual names. The other thing too is just even if you can't implement risk parity, it perhaps can provide like a reference, with the idea being that the weights to risk parity are pretty easy to calculate and they're relatively robust. So it's a good reference point for your portfolio, particularly if you're doing something more exotic like mean variance optimization. It's a good sanity check. So even though it's not a good idea to implement risk parity, at least in my opinion, in today's market environment, that it still has some useful ideas that you can take from it. And once you start to go down the path of risk parity, there's a very powerful concept that you may not fully appreciate at this point, but if you get more experience or you think more deeply about it, it's a pretty powerful idea. And so that idea is that we almost implicitly think about a portfolio being fully invested. And so if the market portfolio happens to be, if the market happens to be in a high risk environment, then your portfolio has a high volatility, or it's a high risk portfolio. If we happen to be in a low risk environment, then similarly your portfolio reflects that low risk environment or low volatility environment. But that's not really ideally what you want. You ideally want to target a constant level of volatility. And so what you can do is you can scale up and scale down your asset classes or your investments in general to maintain a constant volatility. So you can imagine something like say using a model for forecasting volatility based on the, like maybe an AR1 model with some decay or whatever. So it kind of has like this idea of what like a long-term equilibrium volatility is, plus it takes into account the recent historical volatility, so that it would scale up or down your positions, so that your positions will be lower when the market is in high volatility regime, and vice versa, which means that you as an investor manage to maintain a constant volatility of, like, let's say you could target like a 10% volatility or 15% volatility. And in fact, there are ETF, there are indices that target a fixed volatility, and I believe there may be even ETFs that track them. So that in itself is a very powerful idea. And you may have heard that market returns are not normally distributed, and they show like skewness and kurtosis. So they have larger drawdowns than you expect. And so one thing is that if you target a constant volatility, what you tend to do is you tend to make your return distribution more normal. So you actually don't have as large drawdowns as you would have otherwise. And if you think about that, it makes intuitive sense. Because let's say you're running along having a certain weight to equities, and the market starts to become more and more volatile, like happened in the first quarter of this year. What you would end up doing is you'd end up scaling down your positions, so that if the market continued to go down, at least you wouldn't lose as much as you would have without targeting volatility. So that is one very powerful idea. And then the other also very powerful idea is that you can apply this at the portfolio level, and that actually, not only do you end up targeting volatilities, but you end up actually targeting correlations. So what I mean by that is you could target a volatility for say equities, and you could target a volatility for fixed income, but and then if you run those at, say, a constant volatility, but your portfolio volatility will still vary over time, and it'll vary over time due to the correlation between equity and fixed income. And so what that means is if you target a portfolio level volatility, then you're actually also end up targeting volatilities. So in other words, as the correlation between equity and fixed income increased, that would mean that your portfolio volatility would increase if you didn't do anything about it. And therefore, to control the portfolio volatility, you'd actually simultaneously reduce both equity and fixed income, just because they're becoming more correlated. Similarly, the other way around, if it became less correlated, in other words, they're more diversifying, then you would actually be able to run more risk because they were acting as more risk reducing than otherwise. So that's actually a very powerful concept in portfolio construction, and you tend to see this approach in not necessarily for institutional investors running a large portfolio full of privates, but you will tend to see it in, say, people that have portfolios that are entirely invested in liquid markets, and you'll tend to see it with relatively sophisticated investors and hedge funds. And so you can imagine that if you were trading, let's say, via futures, this would be a very easy strategy to implement. And so you could program, you could quite easily imagine writing an algorithm that would, you would feed it in a target volatility for the various markets, and then you could feed in an overall portfolio volatility, and then you'd allow that algorithm to trade in futures to achieve that target volatility. Okay, so we also talked at the very beginning about we talked about ways of weighting your portfolio using return, vol, and correlation, but then we also said that there's a big field of using fundamental factors. And so here I describe a little bit what these fundamental factors could be. And these are ways to measure, like kind of get a sense of fundamental value in the asset class. So whether the asset class or the assets within the asset class are expensive or cheap. And so with equity, you could use earnings yield, book value, cash flow, sales, dividend yield. And in fact, these last four are put into a combination and actually run as an investment program by, I think it's Research Affiliates. That's what RAFI stands for. Research Affiliates Fundamental Indexing, I believe. In fixed income, so that would be government bonds, you could use GDP or debt to GDP, which would be, measure like debt to GDP with some kind of measure of the country's ability to pay their debt. In credit, you could use the amount of leverage that the company is running. So the more leverage the company, the less weighting you would give to its bonds. Commodity, I left that blank because it's hard to think of something for commodities. So yeah, still haven't thought of anything to put there. Okay, so now this should be the next part will be more like a fun part where we'll go through some price charts, and then we'll take a break, and then I'll come back and I'll walk through the derivation of the maximum Sharpe ratio portfolio and the minimum variance portfolio, and then that'll be it for the evening's lecture. Okay, so what I've done here is I've taken some ETFs that follow like a non-cap weighted strategy and compare it to the market cap equivalent. And so in the first case, what I'm looking at is the S&P 500 equal weighted. So that was the example I talked about at the beginning, where you put like a dollar in every single company in the S&P 500, regardless of its market cap. And that performance is given by the blue line. And indeed, if you compare it to the red line, which is the S&P 500, you'll see it's outperformed. So then you could say, okay, this is actually pretty good evidence for equal weighting. But remember when I said that equal weighting actually is effectively a tilt to smaller companies? So then what I did was I said, okay, there's an ETF that tracks the next 400 size stocks in the S&P 500. So if you take the S&P 500 and you break it up into the top 100 biggest companies, and then the next 400, the remaining 400, that's we call those the mid caps. And there's an ETF with ticker symbol MDY that tracks those 400 mid cap stocks. And so if you look at that green line, actually the green line is even better than the blue line. So it's not so much that the equal weighting, has outperformed the S&P. It's rather that more, it's really just a mid-cap index in disguise. So that's the first example of equal weighting. The next example of another non-market cap weighted approach is what I was talking about, is the fundamental indexing, which is, like I said, it's the RAFI US 1000. So it's taking the top 1,000 stocks in the US market and then weighting them by using this blend of fundamental factors like book value and price to earnings and all the dividend yield, like the four that I noted in the previous slides. So that ETF is the blue line here. And so if you look from the period like up to the financial crisis or 2009, it tracks pretty closely. And then you find its performance deviating or looking better than the S&P 500. And also to make it more fair, I compare it to the Russell 1000 ETF. So that's more of an apples to apples comparison. So it's 1,000 stocks versus 1,000 stocks market cap weighted. So that's the green line, is the 1,000 market cap index. And so sure enough, it looks like for, you know, like a decade or so that the fundamental indexes outperformed. So you think, okay, well, that's good news. But then if you drill down into what actually happened, if you recall, like, well, there was a financial crisis, and so all stocks were cheap, and then this was the stock market bottomed in March 2009. It just so happened that the RAFI 1000 index rebalanced. I'm not sure if it rebalanced quarterly or annually, but let's assume it rebalanced annually. It just so happened that that was its rebalancing date. So at the bottom of the financial crisis, what it ended up doing was heavily weighting on really beaten down stocks that subsequently rebounded better than the overall index. And so that single rebalancing, like almost by luck of rebalancing right at the market bottom, allowed it to maintain a slight outperformance all the way up to kind of relatively recent history. But if you notice, essentially from the coronavirus, it's actually underperformed. So now it's actually below the Russell 1000. So remember when I said that at the beginning that the non-market cap weighted indices had an early good track record, but recently they haven't been performing as well. So this is a perfect example. So this is a case where the fundamental indexing actually doesn't look like it really makes much of a difference. It's just almost like luck or noise. And then let's look at another one. This again is an equal weighted example. And this is to illustrate the idea that the largest cap stock in the index is not necessarily the most overpriced. And this is like a fun question to ask in class, but let me just tell you what you're looking at. So the blue line is the NASDAQ 100 equal weighted. And so it's the tech stock index, the large cap tech stock index. And then the red line is the traditional market cap weighted NASDAQ 100. And so you see that the red line has significantly outperformed the blue line. And that's counter to the theory. And so the question is, well, why is that? In fact, it's not even close, and it's not even in like the right direction. So this is a great example countering the logic of equal weighting. And if you kind of have any intuition about it, the reason is because the most expensive, the largest cap stock in the NASDAQ is Apple, and Apple has significantly outperformed the other stocks in the index. So what you had happen was that the largest stock, cap stock, which fundamental index or fundamental indexing would suggest to you that it's overpriced, it turned out to be opposite case. Even though it was huge, it was actually still cheap, and it continued to do really well. So I think that explains the bulk of that performance. So again, this is another example for the intuition behind non-cap weighted indices doesn't really hold in practice. Then here's another interesting example. This is a ETF that was created by academics, and this was EdHec, which I actually mentioned in the very first lecture. And what they did was they said, okay, there's all these different weighting schemes, and there's all these different things to optimize to. And so what we're going to do is we're going to build like the best of all worlds. So what we're going to do is we're going to average over all the best possibilities for reweighting a portfolio and all the best metrics, and we're going to blend them together so that you should kind of receive the kind of expected performance of the non-cap weighted approach. So in other words, it shouldn't be sensitive to any particular outlier behavior like Apple outperforming or rebalancing on a particular date, because this averages over all those different approaches. And so theoretically, this should have been a great product. So the ETF is SBUSB. So diversified factor US large cap. So it's essentially like the best of breed non-cap weighted version of the S&P 500. But what you notice is that if you look at the graph, that it's all kind of like for this ETF, which is the blue line, it's all kind of has these funny like flat parts and spikes, and it has this weird drawdown here, and you see the S&P 500 and it just kind of bounces along quite happily. And so like one observation is it's not really outperforming, but it doesn't have that much of a track record. But just setting that aside, what you're observing here is that the ETF is actually quite illiquid. So it only attracted a few $1 million in AUM, which is really small. And so that's why you see these flat lines here. That's where the ETF didn't trade. And so, you know, here like the price should have really just tracked S&P, but because there was no trading, it just like flatlined for this period, and then a trade happened, and then it carried on. So we talked about illiquidity not being that attractive because it means you would be paying a large bid-ask spread. So this ETF, because it's illiquid, would be quite expensive to trade. Another aspect of illiquidity that you should be aware of, so you never make this mistake in your trading careers, is that what happens is you can put in a market order for an illiquid share or a share that doesn't trade that frequently. And what can happen is if it's a market order, is that there's nobody, I guess in this case, somebody came along and submitted a market order to sell the ETF, and there was no buyers for the ETF at the current market price or even near the market price. So what happened was it went through all the price levels until it hit somebody that had put in like a really low bid for the price. So in fact, like 25% below. And so because somebody mistakenly put in a market order for an illiquid share, they got filled, but at a ridiculously low price. And it wasn't so ridiculously low that the trade got reversed or anything. And so they would have regretted putting in that sell order. So that's something to be careful about. And also just to be aware that there are high frequency traders that have just put low-level quotes on every single stock. just waiting for these opportunities. So in a sense, they're actually adding some efficiency to the market, because this probably hit minus 25% and hit one of those people that just have some, you know, that constantly have a very low bid. But there's probably somebody else that had like a bid at like minus 40% and somebody minus 50 and minus 70. So at least the person got filled at minus 25, and it actually could have been worse. But the lesson for you guys is to make sure that you never put in market orders for illiquid stocks. So that's my second gift to you. My first gift was the trading strategy of shorting 2 offsetting leverage ETFs, and the second gift to you is always put in limit orders for illiquid stocks. Okay, so yeah, then there's some other issues with trying to do non-cap weighted indexing. So one example would be like, what do you do if a company is for whatever reason is just shrinking? So this could be like an obsolete, like it could be like, you know, the blockbuster of its time, and it keeps getting smaller and smaller. So if it keeps getting smaller and smaller, are you going to keep allocating more and more to it just to keep it's like, you know, like a fixed weight to it, which is what would be happen if you follow like a 1/n approach. The other issue is to think about its capacity. So if you're following this strategy, then the amount of capital you can put in it is limited by the smallest size stock. So remember I said that at the very beginning that for anybody that's doing equal weighting, somebody has to be the opposite side of that trade. And so there are only so many people available to be on the opposite side of that trade. And so that will constrain the capacity for these strategies. Okay, and then I just want to set up the exercise for the 2 special portfolios before taking the break and actually deriving the weights to them. And so here's the intuition, and this is a screenshot from a little like spreadsheet that I put together that would build out the efficient frontier without risk-free assets. So you see that kind of, it's actually, I looked it up, it's a hyperbola shape. So this is like 1/2 of the hyperbola branch. And so I'm able to construct that. Remember I said that you only need 2 portfolios to construct the efficient frontier, the straight line efficient frontier. So, and the most convenient ones would be the risk-free asset and the maximum Sharpe ratio portfolio. Well, it's the same thing here with the efficient frontier, even if it's not a straight line. All I need is 2 portfolios, and then I can map out by linear combinations the rest of the efficient frontier. And so the portfolios I picked to do that is the minimum variance portfolio, which is that guy right there at the very bottom. It's like where the parabola turns over. So it's the minimum volatility that you can obtain. And so that's one special portfolio. And in the next, after the break, I'll derive the weights for that portfolio. And then another one is the maximum Sharpe ratio portfolio, which would be the one if I extended this, you know, the tangent line to the origin, assuming these are excess. The tangent portfolio would be the maximum Sharpe ratio portfolio. And again, I'll derive the weights for that. And once I have those 2 portfolios, then I can build the entire efficient frontier without a risk-free asset. Okay, so that's the setup for why it's so powerful to actually have these, to be able to analytically get the optimal weights for these 2 portfolios, because it actually gives you the entire efficient frontier. Okay, so let me stop sharing temporarily, and I'll check in if there's any questions. Okay, so let's take a relatively short break and come back at 8, and then I'll go through the derivation of these two portfolios. It'll probably take me like 20 minutes to half an hour, so we should be able to wrap up early, and you guys can get a bit of an earlier start to your weekend. Okay, so I'll see you at 8 o'clock.